Good morning, everyone. My name is Anuj Jindal, and today we are going to discuss the next chapter, that is chapter 3 of Economic Survey 2017-18. Now, it's very important for me to tell you all that whatever I'm discussing here is not like what you have been getting from various institutes for UPSC as well as RBI. There are a lot of facts and numbers that have been missed out by them, a lot of analysis that have been misinterpreted by them, a lot of things that have been done in a wrong way, and I am here to correct all those things. So the chapter that we're going to discuss is called as Investment and Saving Slowdowns and Recoveries, Cross-Country Insights for India. So the focus of this chapter is on investments and saving, the connection between investments and savings. So let us start with our discussion on the chapter. So first of all, through this slide, we can see that there are certain interpretations or there are certain insights that we get through this slide. So this is with respect to India and this is with respect to average of certain sample economies that are mostly advanced economies plus certain emerging economies. And what this tells us is that investments, first of all, reached their highest in the year 2006 2007. Secondly, investments as well as savings in India have always been high since 1991, almost 25%. Investments as well as 25% of GDP are the savings, and they're still very high at almost 30%. We also see something else, that is savings are higher normally, and most of the times they are higher than investments in India. That tells that India is very much concerned about its savings. It's a saving society, which we already know as a generic statement. And the next thing that we get and that we can interpret is the fluctuations that we can see here. So after 1991, in the year 2000s, we saw sudden boost in investments, which started slowing down from the year 2012, and since then they have been slowing down consistently and continuously. They have yet not picked up even after the economic recession has got over worldwide, and the economic growth is going up worldwide. India is still seeing a slowdown in its investments and savings, but they're still at a very high number at almost 30% of GDP. On the other hand, when we see investment and savings data for the average of sample countries, we see that the fluctuation is much less since 1991. See, it's a very flat graph. Savings are much less than investments, unlike India, wherein savings are more than investments. And the average savings as well as average investments is around 15 to 20%, and very rarely touching the graph, the line of 25%. So this is something that we can see from these two charts. So what are the interpretations or what are the conclusions that we can make? Investment, which is also called as gross fixed capital formation, which is net investments in the economy. That is, investments that are coming in or that are happening in the economy in various capital fixed assets minus investments that are going out, or for example depreciation that is happening on these capital assets is reduced, in order to find out the gross fixed capital formation. Investment rate and gross domestic saving rate are actually above the levels that prevailed throughout the 1990s. So we can see from this graph that although investments have gone down, but they're still higher than what was the rate in the decade of 1990s. Second is the boom of 2000s was actually an exception. It was not a normal trend, and we can interpret this or we can conclude this by comparing our economy with the average of world economies. So we see that the average is around 20%, but our investments and savings were around 35% in this era of 2000s, and therefore it was an exception. As India's climb to about 10% real GDP growth was accompanied by an unprecedented 9% point pickup in domestic saving and investment rates. The subsequent slide in investment and savings as a percentage of GDP has merely brought these rates back towards normal levels. So a lot of people are saying that investments and savings are low, but actually they're not low. They're very much in line with the world average, and they're very much normal at this level right now. But we need higher investments because India, being a developing country with very heavy population, needs more investment in order to grow faster. Such sharp swings in investment and saving rates have never occurred in India's history, not during the BOP crisis, nor during the Asian financial crisis of 1990s. So in 1998, when the Asian financial crisis started showing up, even then the investments rate did not fluctuate much. So it was very much in the average of 25%. But as 2000 set in, the investments as well as saving rates started fluctuating upwards. Sectors, what are the sectors responsible for this decline in investment as well as saving? Number one, fall in private investment and household or government saving. So we will also have a look at the proportion of household and government saving as a proportion of the entire savings in India, and also what are the proportion of private investments. The fall in household saving has in turn been driven by a fall in physical saving. That means a fall in saving in terms of gold or land. All these have also gone down, partly offset by an increase in the holding of financial assets. So financial assets holding rates have gone up. What we see here is sectoral composition of gross fixed capital formation. Very, very important. Can be asked in the examination, picking up from this particular information here. So when you see at the sectoral composition of gross fixed capital formation, you will see that the household sector is one major contributor to gross fixed capital formation, and such is similarly it is private non-financial corporations. This means that the household sector is investing a lot in machineries, let's say households, construction, and all those kinds of activities which are resulting in certain capital formation in purchase or setting up of capital formation. And similarly private non-financial corporations, for example in industry, a manufacturing industry which is involved in, let's say, manufacturing cycles, that is also investing a lot in capital formation, in fixed capital formation. So intellectual property is less, but the majority is by machinery and equipments. And then you have dwellings, other buildings and structures being the majority contributor towards household sector's gross fixed capital formation. So this is an important information that we have attained from this. Now something about the gross savings. So out of the total gross savings, which are still almost 30% of India's GDP, you have non-financial corporations first, which have 11.8%. Second is general government, which has a negative presently of -1%. That means they are not they're spending more on capital outgo rather than what they are spending on fixing or raising new capital. That means the depreciation and the amortization on their existing assets is much more. And household sector is the maximum at 18.7%. So this is something that you need to remember. Non-financial corporations become a part of private, out of which you have public non-financial, and then you have public financial corporations. So this can be eliminated. Even if these two things are eliminated, you have non-financial corporations or financial corporations at one second. Financial corporations have 2.1%, private non-financial corporations 10.8. So first is household at 18.7, second is non-financial private corporations at 10.8, third is non private financial corporations is fourth. So third is public financial and non-financial corporations at almost 1.3%, and fourth is we have private financial corporations at 0.8. So this is something that we can attain from this particular, and it's very important, the percentages as well as the rankings. Okay, so this is an important graph which I've got from RBI website, recent graph which shows the contribution to GDP from this time period to this time period of all these three: private consumption, government consumption, gross fixed capital formation, and net exports. So we see that private consumption has increased subsequently. Consistently, private consumption has been increasing as a percentage of GDP, or the contribution to GDP, let's say, is increasing, because GDP is calculated by consumption plus investment plus government expenditure plus net exports, that is exports minus imports. So this is the formula for GDP calculation. Out of this, private consumption is a majority of almost 4%. Next is you have government consumption or government expenditure. Then you have gross fixed capital formation, that is investment, and then you have net exports. So this is the entire breakup of GDP of India from these four perspectives. Next is index of industrial production. So this is not related to what we are discussing, but I found this on RBI website in the same document, and I thought it's important that we discuss this right there as well. So overall index of industrial production for India is almost 2% from April to June of 2017-18 as per RBI, and these are the core sectors, and out of these core sectors these are the contributions. So majority is electricity 5.3%, consumer non-durables are at 7.7, but this is not in the core sector. And then you have manufacturing 1.8, primary goods also not a core area. Then you have 1.3, that is manufacturing. So all these numbers are given here, you can go through them and try to mug up these numbers because they are very important. Whatever latest data is going to be available on RBI website, we are going to discuss that as and when it arrives. Next is some important definitions. So you define three things here: slowdown year, slowdown episode, and shortfall. What exactly are these three numbers? These three terms. Slowdown year is defined as one where the shortfall in that year exceeds a certain threshold. What is a shortfall? A shortfall is, let's say, average investment minus average savings. So when you reduce or deduct average savings from average investments, you arrive at shortfall. And when the shortfall is more than a certain threshold, that is 2%, 3%, or 4%, it might be anything depending upon what the government wants it to be. Let's say the shortfall is 2% this year, then it becomes a slowdown year. Let's say last year it was 20%, this year it is 18%, or last year let's say it was 21%, and this year it is 19%, next year it is 17%. As soon as it reaches 20%, the shortfall or the slowdown, sorry, is removed, because now the shortfall is not in that threshold. The shortfall threshold is, let's say, 2%, so that 2% threshold has been broken, and therefore it's no more a slowdown year. If there are two or more consecutive slowdown years, then it becomes a slowdown episode. And shortfall I have already discussed. Secondly, first slowdown is calculated through this. Second is the average investment rate for the 5 years prior to slowdown year is at least 15% of GDP. So this is important for you to remember. What this says is that the average investment, in order to find out a slowdown year, you see that the average investment is at least 15% of GDP. It is, if it is less than 15% of GDP, then there is a potential that it can be called a slowdown year or a slowdown episode. The next one that we have says that investment episodes in India are more frequent than saving episodes. That is investment slowdown episodes. This is what it means, investment slowdown episodes. That is, the savings are less vulnerable or less volatile, but investment is more volatile or more subject to large fluctuations. While common episodes where both investment and saving are slow are relatively unusual. This pattern has reversed after 2008 due to concerted efforts of emerging economies to revive investment after the global financial crisis. So this says that investment slowdown episodes have reduced now, because now the emerging economies are working very hard towards reviving investments. Investments and saving slowdowns tend to be similar in duration. However, investment slowdowns are greater in magnitude and are more prone to extreme events. Not very important. Cross-country listing of investment and saving slowdown reveals slowdowns are quite frequent even in success stories like China. So volatility does not mean that there is some problem in that particular economy. There is going to be volatile, there is going to be slowdown, either saving or investment. What we need to see and analyze is what is the average investment and saving happening in the economy, which is very healthy in India at present also. India's current investment or saving slowdown episode has been lengthy compared to other cases, and it may not be over yet. So this is something that we can interpret from this particular graph also. So what we see here is investment as well as savings are consistently going down. So these are consistently reducing, and that is a cause for worry for India. The next is investment. India's investment slowdown is unusual because it is moderate. It is not steep, but it is still long. It is still going on. The slowdown is still going on, and we don't know where is it going to stop. And what kind of slowdown it is? It is actually a balance sheet related slowdown. So, what is a balance sheet related slowdown? That is, many companies, and this is also responsible for twin balance sheet problem in India. Many companies who had raised their investments, who had raised a lot of investments or invested a lot of money in their industries, are not able to earn profits, enough returns on those investments, and therefore two things are happening. Number one, they're unable to pay back to the banks whatever loans or whatever debt they had raised. Secondly, they are not willing to make additional investments. They are not willing to do this because their existing investments have still not paid them returns, and therefore investments are going down. India's investment decline so far, that is 8.5 percentage, has been unusually large when compared to other balance sheet cases. Not very important. So this is a data which I picked up from World Bank. Every 1% fall in investment dents 0.4 to 0.7% of growth. How to resolve this investment slowdown? Number one, we need to reverse this phenomena. And secondly, public investment was given by Keynes during the depression of 1929, and he said that whenever there's a slowdown like this, public investment needs to shoot up, and that is what happened in India in 2015-16. Public investments were suddenly raised, and therefore the fiscal deficit also remained in a unhealthy situation or level. But public investment cannot be increased after a certain level, and now this is what it says, that there are constraints on public investment, and therefore we need to resolve this particular problem of twin balance sheet issue. So certain other measures that have been either taken or that are still required: easing the cost of doing business so that private investment, either overseas or domestic, can increase in the economy, because when the cost of doing business goes down, then the profits for business shoots up, and therefore they are more incentivized to invest and start businesses in the country. Creating a clear, transparent, and stable tax and regulatory environment, creating a conducive environment for small and medium enterprises. Very specific. How to reverse this saving and saving slowdown and revive growth? These are some things that I have created on my own. Mobilize savings. You need to, and steps have already been taken. Some steps have already been taken in these directions. You need to unearth black money. In order to mobilize savings more, you need to convert physical savings to financial savings, which is already happening through financial inclusion and through the incentives that have been given to people to invest in instruments like mutual funds, and to for go for financial inclusion. And cashless economy also reduces or reverses the savings slowdown, because then more money is available in the banks, which is going to increase the lendings by the banks, which is going to further increase the investments by the banks, and therefore it's important that we go more towards a cashless economy, because it has a multiplier effect on investments and savings in the economy. So this is about this particular lecture on chapter 3. We are also going to discuss chapter 4 very soon, which is very important related to federalism in India.